All right, let's dive into this one. The Little Book of Common Sense Investing.
A classic.
Yeah. You sent this one over, and I've got to say, John Bogle, founder of Vanguard, pioneer of index fund investing.
Absolutely.
We've got to unpack this.
Yeah, let's do it.
See if this common sense approach is all it's cracked up to be, right?
Right. And if it's right for you.
Yeah, exactly. For our listeners out there, have you ever felt that, is there a simpler way to grow your wealth without, I don't know, the stress of trying to time the market or pick the next hot stock?
That's what everybody wants to know.
Right.
A simpler way.
Yeah, and Bogle, he comes right out of the gate, right?
He does.
With this parable of the Gottschalks family.
Yes.
And it's so clever. They own every single business in America.
Every single one.
Could you imagine?
Yeah.
And then they start hiring all these helpers, right? Brokers, advisors, you name it, thinking these folks will help them get an even bigger slice of the pie.
Yeah.
But here's the thing. The more helpers they hire,
the smaller their piece gets.
Isn't that interesting?
Oh, yeah.
So it's like this brilliant illustration of how, for investors overall,
the more you move around in the market,
the
less you actually make.
Wow. So are we all just stuck on this financial treadmill going nowhere?
Well, not necessarily.
Okay.
Bogle argues that trying to beat the market is a game that most people lose. He actually presents data in the book.
Really?
Going back over a century, showing that in the long run, stock market returns actually mirror the growth of businesses themselves.
Oh, interesting.
So think about it. You're buying a piece of a company. So shouldn't your returns reflect how well that company does over time?
Makes sense. But what about emotions?
Ah, yes.
Right? I mean, even Harvard University.
Right.
Their giant endowment hasn't consistently outperformed the market.
Yeah, that's right. And, short-term market swings, they're driven by all sorts of things, speculation, news headlines, all of that. But the long-term trend, it's tied to how those companies actually perform. And this is where Bogle says, and this is one of his big things, cast your lot with business.
But what does that even mean?
Well, he's talking about owning a diversified slice of all U.S. businesses.
Okay.
And letting that investment ride for the long haul. You're essentially participating in the overall growth of the American economy.
So I buy a little bit of everything.
Yeah.
Is that where index funds come in?
Exactly. Index funds let you buy the entire stock market in one go.
Oh.
You're not trying to pick individual winners or time the market. You're just capturing the growth of the entire market itself.
So Bogle's basically saying, keep it simple, stupid.
Well, he uses this idea called Occam's razor.
Okay, Occam's razor.
To illustrate it. The simplest solution is often the best.
Got it.
And, sometimes the simplest solution is the best one.
Okay. So then how do I choose an index fund? What are those benchmarks I keep hearing about? The Dow Jones and the...
Yeah. So think of those as like a measuring stick for the whole market.
Yeah.
So the S&P 500, that tracks their performance of 500 of the largest U.S. companies.
Okay.
While the total stock market index includes thousands of stocks.
Oh, wow.
And in the book, Bogle shows how closely these indexes have moved together over time.
Oh, really?
Proving that owning a broad slice of the market is a reliable way to capture its returns.
Okay. That makes sense. But, Wall Street always says you need to hire these experts to manage your money. So how do I know if I'm getting good advice?
Well, this is where Bogle's relentless rules of humble arithmetic come in.
Ooh.
He really breaks down how costs impact your returns over time. And it's not just management fees. It's also trading fees, taxes. They all add up.
It's like death by 1,000 paper cuts.
It really is.
Yeah.
And he uses a really powerful example in the book. He shows what happens to a $10,000 investment over 50 years.
Really?
And with an 8% return before fees, that investment grows to almost $500,000. But even a seemingly small 2.5% annual fee shrinks that final amount to just over $100,000. That's a difference of almost $400,000.
Oof. So finding low-cost investments, that's crucial.
Absolutely.
But what about those fancy returns that funds advertise? Are those returns I can actually expect to get?
Well, not necessarily.
Okay.
Bogle calls this the grand illusion.
Okay.
He argues that the returns reported by mutual funds don't reflect what investors actually earn because of this thing called bad timing.
Bad timing, like showing up late for a meeting.
Sort of. Investors often chase performance, piling into funds that have done well recently, which usually means they're buying high.
Oh, okay.
And then they panic and sell when the market dips. meaning they sell low.
Oh, so they're always one step behind.
Exactly.
Yeah.
And the book has this incredible chart showing how investors in the average fund actually earn significantly less than the funds themselves reported. And get this, almost 200 of the 200 most popular funds over the last decade actually delivered lower returns to investors than they advertised.
That's wild. So chasing the hot new fund, recipe for disaster.
Yeah, it can be.
What are we supposed to do instead?
Well, there's one more silent killer of returns we got to talk about. Taxes.
Ugh, everybody's favorite topic.
Yeah.
Taxes, okay. How do taxes impact my investments?
So actively managed funds, they're constantly buying and selling stocks.
Right.
Which triggers taxes with every transaction. And guess who pays those taxes?
Me.
Yes.
Oh, I hate that.
Yeah.
Okay.
Index funds, with their buy and hold strategy, generate fewer taxable events, making them much more tax efficient.
Okay.
And in the book, Bogle compares the after-tax returns of the average fund versus an index fund, and the difference is significant, especially over the long haul.
Okay, so low costs, avoiding market timing traps, and minimizing taxes. Got it.
You got it.
But haven't stock market returns been pretty great these last few years?
They have.
Will that continue?
That's a good question. And, Bogle's actually cautious about future returns.
Really?
He believes that the performance we've seen over the past 25 years might be an outlier.
Okay.
Driven by a speculative boom. And he argues that if we adjust for that speculation, future returns might be more in line with historical averages, which are lower than what we've seen recently.
Yikes. That's a sobering thought. So what, we should just throw in the towel and hide our money under the mattress?
No, not at all. But it does underscore the importance of keeping costs low, diversifying properly, and having a long-term perspective.
Okay.
In a lower return environment, those factors become even more crucial.
Got it. So I get that chasing returns and trying to time the market is a bad idea. But with so many funds out there, how am I supposed to choose the right ones? Is there a secret formula?
Well, a lot of people think past performance is the key.
Okay.
They look for funds that have done well recently, assuming that means they'll continue to outperform.
Right.
But Bogle argues that this strategy often fails.
Because past performance doesn't guarantee future results.
Exactly. And, he shares some pretty shocking data in the book. Out of hundreds of funds that existed in 1970,
wow,
only a tiny handful have consistently beaten the market over the long term.
Oh, wow.
It's incredibly difficult to predict which funds will be the winners, even for the so-called experts.
So if past performance is unreliable and chasing hot funds is dangerous, then what's the secret?
You ready for this?
Yeah.
The most reliable predictor of future fund performance is low costs.
Oh.
It might not be exciting, but it's powerful. Bogle's research shows that funds with the lowest costs consistently outperform those with higher costs across all types of markets.
So it really is all about keeping it simple.
It really is. That's the foundation of Bogle's investment philosophy. And in the next part of our deep dive, we'll explore how this simplicity translates into building a portfolio and achieving your financial goals.
Okay, I'm ready for part 2. All right, welcome back to our deep dive on The Little Book of Common Sense Investing by John Bogle. And, one thing that really struck me is this emphasis on discipline and patience. Oh, absolutely.
He talks about compounding.
Yeah.
But he also talks about how costs compound, too.
Right. It's this incredible force. Your returns generate more returns over time. But the flip side is that costs can also compound, and they eat away at your gains.
Right. So time is our friend when it comes to returns.
Yes.
But our enemy when it comes to cost. Okay, so let's get practical here. How do we actually put this philosophy into practice? Because Bogle talks a lot about asset allocation.
Yeah.
What does that even mean?
So asset allocation is simply deciding how to divide your investments among different things like stocks, bonds, real estate.
Okay.
And you're looking for that right mix based on, how much risk you're comfortable with, how long you have until you need the money, and what your financial goals are.
So if I'm younger and saving for retirement way down the road, I could probably handle more risk.
Yeah.
Does Bogle offer any guidance on how to figure that out?
He does. He suggests a simple rule of thumb.
Okay.
Your stock allocation should be roughly equal to 100 minus your age. Okay.
So if you're 30 years old, you might have around 70% of your portfolio in stocks and 30% in bonds.
Gotcha.
Then, as you get closer to retirement, you gradually shift toward a more conservative mix.
Makes sense. That's a really helpful starting point. But what about when the market, goes crazy like it does sometimes?
Right.
Do I just sit back and watch my portfolio like swing wildly?
Well, that's where rebalancing comes in.
Okay.
It's about periodically adjusting your portfolio.
Okay.
To get back to your target allocation. So let's say your goal is 70% stocks and 30% bonds. But after a market boom, your stocks have grown to 80% of your portfolio. Rebalancing means you'd sell some stocks and buy more bonds to get back to that 70-30 split.
It feels kind of wrong to sell something that's doing well, though.
I know, it can feel counterintuitive.
Yeah.
But it's actually a disciplined way to manage risk and potentially boost returns over time. You're selling high and buying low, essentially, taking advantage of market fluctuations to keep your portfolio aligned with your goals.
It's almost like taking some chips off the table when you're winning at the casino.
Yeah.
Just so you don't lose it all later.
That's a great analogy. And this ties into another important point Bogle makes. Managing your emotions.
Oh, yeah.
It's so easy to get swept up in market hype or panic and make impulsive decisions.
Totally.
He encourages a more, rational, rules-based approach. So you're not making choices based on fear or greed.
Yeah. Easier said than done. Right. But having a plan and sticking to it, even when things get volatile.
Right.
Seems like a key takeaway here.
Exactly. It's about remembering that investing is a marathon, not a sprint. Now, speaking of simplifying things.
Okay.
Have you ever heard of target date funds?
Oh, yeah. Those are really popular in, retirement plans, right?
Yeah, they are.
You just pick a fund based on when you plan to retire.
Uh-huh.
And it magically takes care of everything.
That's the idea. They automatically adjust your asset allocation as you get closer to retirement. It's becoming more conservative over time. It's like having a built-in financial advisor.
So Bogle loves target date funds, right? Seems right up his alley.
Well, he actually does support them, but with a very important caveat.
Oh, okay.
He stresses that target date funds should be invested in low-cost index funds.
Ah, okay.
Otherwise, you're still losing a big chunk of your potential returns to fees.
It always comes back to those fees. And, Bogle is pretty outspoken about the mutual fund industry in general.
He is.
He seems to think that, they're not always acting in the best interests of investors.
Yeah, he's definitely critical of how the industry often prioritizes profits over people. He points out that the focus on gathering assets and launching new products often comes at the expense of investor returns. There's a real conflict of interest there between fund managers who profit from high fees and investors who are just trying to build wealth.
It's kind of like going to a restaurant where the waiter gets a bigger tip if they convince you to order the most expensive dish.
Yes.
Even if it's not the best choice for you.
That's a great way to put it. Bogle believes the mutual fund industry needs a major overhaul to better serve investors. Now, he does acknowledge that there are some actively managed funds that can actually add value.
Okay.
But those are like unicorns, right?
Yeah.
Super rare.
Yeah.
And even then, he suggests focusing on funds with low costs, experienced managers, and a consistent investment philosophy. Don't just chase performance. Do your research. Make sure the manager's approach aligns with your goals.
So even though Bogle's all about index funds, there's still room for active management. If you're careful and you do your homework,
absolutely,
it all comes back to being an informed investor.
Yes. And it's important to remember that Bogle isn't just talking about investing in isolation. He's really talking about achieving overall financial well-being.
Okay.
So it's bigger than just picking stocks and bonds.
Yeah, it's like having a healthy relationship with money overall.
Exactly. He emphasizes the importance of saving consistently, living within your means, and avoiding unnecessary debt. These are the fundamental building blocks of a solid financial life, regardless of how you choose to invest.
So he's really preaching financial responsibility, not just investment strategies.
That's right. And I think that's what makes his message so powerful. It's not about getting rich quick or beating the market. It's about building a secure and fulfilling future for yourself and your family.
Yeah, well said. We've covered a lot of ground here. Bogle's philosophy is all about simplicity, focusing on what you can control, taking a long-term perspective.
Right. He reminds us that investing isn't about outsmarting the market.
Yeah.
It's about achieving your financial goals and living a life of purpose.
So are you ready for the final part of our deep dive? We'll explore some of the broader implications of Bogle's philosophy and leave you with some final thoughts to ponder. All right, so we're back for the final part of our deep dive into the Little Book of Common Sense Investing by John Bogle. And, we talked a lot about strategies and numbers, but I feel like Bogle he goes beyond that.
Right.
It's not just the mechanics of investing.
He's asking us to think about the bigger picture, right? Not just how we invest,
Yeah.
but why we invest.
Yeah, he reminds us it's not just about making money. It's about securing our financial future, like living a life of purpose. I almost feel like, is he challenging us to be better investors? Not just like in terms of returns, but ethically too.
That's a great point, yeah. He really calls for this kind of like shift in the culture of investing, from this speculation and short-term thinking to long-term stewardship and responsible ownership.
Yep.
You're not just buying stocks, you're becoming a part owner of these companies.
Yeah.
And that comes with certain responsibility.
Yeah, it's almost like he's saying we need to be our own advocates.
Yes.
In the financial world. We can't just blindly trust the advice of, brokers or fund managers.
Right.
We have to educate ourselves.
Absolutely.
And make informed decisions that align with, our values.
You got it. And, Bogle, he believed that everyone should have access to these simple, low-cost investment options that allow them to participate in the growth of the economy and achieve their financial dreams. And, he wasn't just talking the talk. He walked the walk. He founded Vanguard Group, which is a company that is structured to put the interests of investors first.
It's pretty inspiring, to see someone who achieves so much success, but also be so committed to making a difference for everyday people.
Absolutely. And, as we wrap up this deep dive, I think it's important to remember that investing doesn't have to be complicated. Bogle, he argues that the simpler, the better.
Yeah.
Focus on what you can control. Minimize costs, diversify broadly, stay the course, don't get caught up in the hype or try to time the market.
Yeah.
Just be patient. Let the magic of compounding work its magic.
And it's not about beating the market.
It's not.
It's about achieving your financial goals.
Right.
And living a life that's meaningful to you.
Absolutely.
So, does Bogle's philosophy resonate with you? Does it make sense for your own investment journey?
There's no right or wrong answer. But by reflecting on these ideas and considering how they apply to your life, you're becoming a more informed and empowered investor.
Yeah, and that's what this deep dive has been all about. Empowering you with the knowledge and tools to take control of your financial future.
Absolutely. Keep exploring, keep learning, and never stop asking questions.
I love it. Well, thanks for joining us on this deep dive into the Little Book of Common Sense Investing. Until next time, keep learning and keep diving.